So thoughts on a 50-year loan, and do I think that it's going to get approved? So I have mixed feelings, to be honest with you, about a 50-year loan. I think in the context that everyone is discussing it in, I don't think that you doing a 50-year loan versus a 30-year loan really does anything to solve the issue of home affordability, which is kind of like where the conversation is centered around. If you look at the numbers, the difference in monthly payment, on like a $400,000 house, the difference in monthly payment between a 30-year fixed and a 50-year fixed is very, very, very minimal. It's like a couple of $100 a month. So, if your make or break on a house purchase is a couple of $100 a month, then I am of the belief that you need to reconsider purchasing a house at that price point. It's not affordable if $200 is the difference between you doing it and not doing it. The other thing that I'll say is that we already have 40-year loans available. 30-year fix is kind of what you hear about, but in the non-QM space, which I'm pretty heavy in, we do quite a few of these non-traditional loans. They have a 40-year interest-only loan where the first 10 years you don't pay any principal back towards the loan. You're only making the minimum interest payment, and then after that 10-year period is up, then you have a 30-year fixed loan and you start to pay down, albeit a very small amount of principal. Um, but still, those things exist. So where I do see a little bit of benefit in a 50-year loan, um, is it even if the cash flow is low for like real estate investors who are buying 30 properties on financing, that $200 a month times 30, that could allow them to buy 32 properties with the same monthly cash flow and allow them to leverage a little bit better. But for your average, like first time home buyer that's trying to make ends meet, they're trying to afford a house in the market with interest rates at 6-7% when home prices are the highest they've ever been. I don't think that 50-year loan does anything to solve that problem. That's a much more complicated conversation. um, because at the end of the day, these 50-year loans, if they do end up getting rolled out and they do end up getting taken advantage of, if you look at the actual um, they're called amortization tables, and it shows basically every month, year by year, how much you're paying towards principal and how much you're paying towards interest. You are paying so little principal on these 50-year loans that they will be wildly, wildly profitable if they start getting adopted on like a wide scale. Um, the banks that loan this money are going to make a ton of money basically if somebody holds that loan, out to maturity. It's pretty staggering if you look at it side by side of like a 30-year fix compared to a 50-year, over the first 5 years of that loan. How much is the difference in out of pocket? And it's like over 5 years, like whatever, $8,000 difference, but the difference in principal is like 40 grand that you pay off, on a 30-year versus a 50-year. What I always end up going back to, in this conversation is when you look at the numbers, 30-year versus a 50-year, it also is worth talking about looking at the numbers 30-year versus 15-year. Because when you start to compare a 15-year fixed loan to a 30-year fixed loan, the 30-year fixed loan almost looks predatory, when you start looking at, oh, well, you pay down this much more principal, you pay this much more out of pocket. So I don't think that there's really like a correct answer. Obviously, a 30-year fixed and a 50-year fix, like these longer loan terms, you're going to pay a lot more money in interest over a period of time, but it can make homes affordable, um, in the short term when you compare to a 10-year or a 15-year or like a shorter loan term. So I think there's a little bit of give and take, with this. Obviously, like if you're looking at any of this stuff, the and this doesn't really apply to when rates were 2%, you know what I mean? But like at a 7%, 6%, 7% interest rate, you know what I mean? You save yourself a ton of money by taking a 15-year fixed and even making some additional principal payments. But the thing is not everybody has that extra $1,500 a month, or whatever the case might be. On a $400,000 house, it's like about $1,200 to $1,500 a month more for a 15-year fix as compared to a 30, and that's not within everybody's budget. So, it's definitely a conversation that like everything I say this about pretty much everything that I talk about. It's based on your individual needs. So like, are there people that a 50-year fixed loan would make sense for? Like, absolutely, definitely. Are there people that a 30-year makes the most sense? 100%. It's the most common loan product out there. Are there people who a 15-year fix, maybe people who make like a little bit more money and they're not stretched to the edge of their budget? Like those people, you're going to save a ton of money. If you sacrifice a little monthly cash flow and go with a shorter term option, you pay off the house, you pay down principal much quicker. and the interest is a lot less front loaded. So, it's a nuanced conversation. I don't really have a strong opinion one way or the other. It's just finance. So, like, it's not good or bad. I just think that everybody, before you get into anything, you should be equipped with the facts about what all the implications of whatever program you select. You just need to know exactly what's going on and not be sold.